Hello everyone, welcome to SST College of Arts and Commerce, SST Edupedia. I am Assistant Professor Deepika Valecha. In this video, we will be learning about buyback of equity shares, which is a topic in Financial Accounting 2 subject of first year Banking and Insurance semester 2. Now, what do you mean by buyback? Before that, what are the various topics we will be learning today in this video, which includes introduction about the buyback, what is the reason for the buyback, what are the legal frameworks relating to the buyback and its advantages, disadvantages, and also what are the various sources and the conditions for buyback. So in all, we will be learning about the legal framework and what are the various conditions in relations to the buyback is. Now, what do you mean by buyback? Buyback refers to a process in which a company takes back the amount of equity shares from its existing shareholders, and they will buy back the shares from the current investors or current shareholders. The reason behind the buyback, it may be a company is having the surplus capital with them, which they need to, which may increases the over capitalization for the company and which may impact on the dividend distribution. Here, the company will reduce the amount of a capital which is not required, and that amount will be used and which will help in increasing the earning per share of the shareholders. So here generally buyback is done on the greater price than that of the market value of the company's shares, and also here in simple words we ask the shareholders to submit their shares in the company and take out their investment amount. So before doing a buyback, a company is supposed to check the legal frameworks and also what are the reasons why the company is doing this buyback activity. See, number one, we have to improve the earning per share. As the capital amount, the number of shares decreases, per share dividend distribution will increase. So here if for example company is having existing shares of 10,000 shares, if a company buy back 2,000 equity shares, so the remaining capital, that is for 8,000 shares, the shareholders will get the good earning per share in the coming years. It is helpful to use the ideal cash. Here, if in case of a surplus cash with the company is required to take the decision what to do with the ideal cash, because the ideal cash will not generate any inflow for the company. To give the confidence to the shareholders at the time of falling the prices. There are many situations where companies' prices may fall. So here, if a company is taking the decision of doing the buyback, here the shareholders will also get the confidence, like the number of shares which the company will be having right away now, that only will get the profits and also the benefits in the near future. To increase the promoters' shareholdings to reduces the chances of takeovers. With the help of buyback, there is a chance that promoters' investments amount shareholdings will definitely increase, as the amount with the external shareholders will get reduced because of buyback. To improve the return on capital and return on net worth, as the earning per share will increase, that will help the company to increase the return on capital and also the return on the net worth, that is for the funds of the equity shareholders, and also to return the surplus cash to the shareholders. Whatever the extra money is there with the company, that amount the company will return to the shareholders, because that will not generate any adequate inflow for the company. Now, let us see what are the legal framework for the buyback of shares. It is compulsory for a company to follow the provisions of Companies Act 2013, which are mentioned for the purpose of buyback, and after following all the provisions only the company will be able to take the decision for buyback. Number 2, we have companies are required to see the share capital and debentures rule 2014 as well in terms of buyback, and also companies are required to follow all the guidelines given by the SEBI, that is Securities and Exchange Board of India, before taking the decision for buyback. Coming to the next point, that is what are the various advantages of buyback of shares. Number 1, we have company having a large amount of the free reserves are free to use the funds to acquire the shares and also the other securities under the buyback process. Now if the company is having excess money, excess amount is there in reserves, in also the capital, the company will utilize that amount for the purpose of buyback. Buyback of shares is helpful for a company to reduce the share capital which is bloated unnecessarily for the time being. As I already explained, the surplus amount of the capital which is not useful, that amount we will give back to the shareholders because the ideal money will not generate any inflow. Buyback of shares results into lower capital base, enhances the post buyback earning per share and appreciate the price earning ratio. Because the number of shareholding will get reduced, the per share amount to the shareholder will surely increase. The shareholding of the company shareholders in terms of price earning ratio, in terms of capital base, in terms of earnings will give the more returns to the shareholders. Coming to the disadvantages of buyback, number 1, there might be the chances of unethical promoters to utilize the company's funds to grow their holdings. Possibility is there that promoters are using this technique for their unethical behavior, and they need to do their own advantage in this type of a buyback of shares. It allows for the modification of the stock prices. Because of buyback, definitely stock price will affect. So here the chances of the fluctuation in the stock prices is more, and it has a potential to divert the cash from more profitable projects. Here possibility is there that the more profitable projects cash inflow will divert to the another projects. Now what are the various sources of buyback? Now in this process, firstly what we are supposed to do, we have to take out the shares from the shareholder and we have to give that money return to the shareholders. So what are the sources, how the company will generate that cash which they are required to pay to the shareholders? There are the various sources of buyback. It includes the amount from its free reserves, that is general reserve, profit and loss account, revenue reserves. Either they can use the amount which is there in security premium account, and also there is an option that the company will go for the fresh issue of the any other type of shares apart from equity shares. Make a note of it, because equity shares are something which we right away now buy back. For the purpose of buyback, we cannot issue the fresh issue of the same type of a shares. We have to go for preference shares issue. So fresh issue is allowed, but apart from the equity shares. So these are the three different ways how the companies will buy back its shares, and various sources they can use. Now what are the pre-requirements, that is what are the various conditions a company is supposed to fulfill before going for the buyback? Number 1, we have to take the prior permission from the shareholders by passing a special resolution into the general meeting, and if that particular percentage of buyback is less than that of or up to 10% of the capital, then the resolution can be passed into the board meeting of the board of directors. Number 2, the maximum number of shares that a company can buy back is up to 25% of the capital, not more than that. That means if a company is having an equity capital of 1 lakh, maximum 25,000 a company can buy back, not more than that. Number 3, maximum amount of shares that can be brought back in the financial year is 25% of the paid up capital. Now there is a difference between subscribed capital, paid up capital, issued capital. So here the maximum amount is 25% of paid up capital and its reserves, and the necessary condition, that is post buyback the equity and debt equity ratio should be 2:1. Only fully paid up shares can be bought back. That means what? If the face value of the shares is 10 and if that 10 rupees is already called up and it is fully paid up, then only the company is eligible for taking those shares back from the shareholders. If, for example, out of 10, 8 rupees are called up, 2 rupees are still uncalled, so company first is supposed to take the call money and after that only they can go for the buyback procedure. Coming to the next point, we have company must declare its insolvency in the form of SH9 to registrar of company signed by at least 2 directors, out of which one must be the managing director. That means what? Company have to give their declaration that the company is not going in any times of the bankruptcy or insolvency. That company is just reducing its capital. It is not going to be bankrupt in near future. Observing the 6 months cooling period during which no new shares will be issued or permitted, a company should not make the buyback offer within a year after closing the last date of buyback. That means what? Say for example, today a company has bought back their number of shares. So from today, 6 months, company cannot issue the same type of shares. That means new equity shares cannot be issued in the period of 6 months. And also after 1 year only, the company can buy back another amount of the shares. So from today, 1 year, company cannot go for second buyback. The company must keep the buyback register in the form of SH10 and submit the buyback returns in the form of SH11 together with the compliance certificate in SH15. So these are the various forms the company is required to submit with the registrar of companies before going for the buyback procedure. And also the buyback must be completed within 1 year of the date of special resolution in the board meeting, whichever comes first. That means what? If today we have taken the resolution that we are going to buy back so and so number of shares, so that procedure must not get delayed and it should be completed within a period of 1 year. So in this video lecture, we have learned what is the meaning of the term buyback, what are the various reasons for it, and how the company is going to do the buyback, what are the prior conditions for the same. I hope this video lecture is useful for you all. Thank you so much.